let's go back to what Jim Cramer had to say. Agree with him that we're just too worried about all this concentration, and really we need to focus on innovation and look for companies that can get to those $2 trillion, $3 trillion marks instead of worrying about the ones that are already there being too much of the market gains so far this year?
I would slightly disagree, Frank. I do think there's concern with this concentration. Look, we've got a 40-year high in these top 10 mega cap stocks in terms of their concentration in the S&P 500. And for sure, they are ripe for correction. I agree with Wilson's comments as well. I think the difference is that would be a buyable dip. I think this innovation is real. I think artificial intelligence is going to continue to change our world. But for sure, we should see some broadening out in the other 490 in terms of their participation moving forward.
All right, so you're echoing the sentiments of Mike Wilson, who we just talked about a short time ago. We've also had Piper Sandler come on and say they're expecting a dip of as much as 10%. So a lot of people worried about that. In fact, I want to ask you about something else. Strategist out with a note yesterday saying in part, talking about the market concentration, though, saying in part the gap between the performance of the market cap and equally weighted index, talking about the S&P, has only been this wide in two other cycles, the late 90s and the late teens. Reversals from such wide gaps are often severe and rapid. So you're saying you'd buy the dip, but are you worried just about the volatility if we do see this reversal that Strategist is worried about?
I expect volatility is going to be par for the course here, Frank, over the traditionally choppy August, September timeframe leading up to the election. But step back and look, fundamentals of the U.S. economy are still good. The employment market is softening, but people are still very comfortable with their jobs. Look at consumer spending. People are still out in hotels and restaurants. The underpinnings of the economy are sound, and we still expect second quarter earnings growth year over year to be up 8 or 9%. So I think it's premature to be overly bearish.
All right. So you're looking at earnings, and I know you're also looking at valuation. So you sent us some research from your team. According to your research, the Mag 7's trading at about 47 times forward earnings, so kind of high valuation. But the S&P 490, if you subtract the top 10 stocks in the index, they're actually trading at 17 times. So as we look at that, and that S&P 490, which is a much, much, much more favorable valuation, where are you seeing the opportunities? Are there certain sectors? Are there certain stocks?
We do see opportunities there, Frank. Couple reasons. So number one, we believe the Fed is going to start lowering rates in that September timeframe due to some of the slowdowns that your other guests have noted. And I think you're going to see investors looking for yield, looking for alternatives to cash. So those S&P 490 companies, the dividend yield is close to 2%, and the valuation is trading at 17 times earnings. So we think there's much greater upside if there's a focus shift in the market from this high beta growth environment, but in a declining rate environment, the cost of capital becomes lower. We think there's a shift more towards these value dividend growers, not just dividend payers, but companies that can grow their earnings and dividends.
Okay, but are those REITs? I mean, what are you talking about? Like, what areas should we look for? Because the 490 is obviously a very diverse group of stocks.
Yeah. So I think outside of technology, healthcare, consumer staples, financials, all of these companies should benefit as the Fed begins to lower interest rates and we see cash moving off the sidelines to seek these higher dividend yields.
All right, so Greg, one last question. You believe that if there's a correction, that's a buy the dip opportunity, but at the same time, you're really bullish on bonds, specifically municipal bonds. I want to ask, why would you have your money tied up in bonds if you think there's going to be a dip and that the innovation story is very real? I know you're in favor of a municipal bond ladder, yield 3.5%, equivalent to a taxable yield of about 6%. But again, why be tied up in bonds right now if you think there's going to be a buyable dip and the innovation is going to continue to push the markets higher?
It's about allocation, Frank. You definitely want to be locking in these high quality muni yields now because we don't think they'll be available in 6 or 9 months. As the Fed begins to lower rates, I think you're going to continue to see the yield curve steepen. I think you're going to see short-term treasuries yields drop, and investors who are used to getting 5% in these money market funds, when the Fed fund rate starts to drop, are not going to be able to reach that. So locking in today these high-quality muni yields, and if tax rates change next year, which we expect that they may, that's going to make the demand for these munis and the demand for that tax-free yield even greater.